Hi, this is John Comarianos with Capital Considered. We're delighted to have a special guest on this week, Jonathan Treussard. Jonathan has really an amazing background, both academic and professional. Jonathan, you studied with Bob Merton. You have a PhD, and you worked at some shops that I'm fond of, including Research Affiliates in Newport Beach. And you have a new wealth management firm now. Want to get into that as soon as we can, but let's start a little bit with your background, both academic and professional, and welcome to the podcast.
Well, thank you. Thanks for having me. It's a real pleasure. Boy, where do we begin? This is all a terrible accident. How's that for
It often
reasonable? When it's interesting, it usually is.
Yeah.
So I grew up in Paris, France. I thought I was going to be a musician. And so when I was 17 years old, after getting my high school diploma in Paris, I got on a plane by myself and I flew to Los Angeles. I thought I was going to be a musician, and I figured that was the thing to do. I had no plan. I spoke very poor English, and I stayed at a hostel in Hollywood.
Wow.
For a few nights, and it was, we're going to call it rustic. It was 8 guys to a room. Which basically meant I was a Hollywood runaway. I just, got on a plane instead of a bus from Kansas or something.
Right.
I shared a bunk with a kid who was, a couple of years older than I was, from Oakland, California, which meant, being 3 or 4 years older than I was, he was a wise old man relative to me.
That's right.
And he said, well, if you want to stay in this country, you may want to get papers. And I literally had not thought that far, along the plan. And he said, well, the easiest thing you can do is to go to a community college, enroll, to a community college, and you'll get a student visa, which I did. So I started my academic career at Santa Monica Community College, and I could not think of a better place to start.
Yeah.
It was truly just what I needed. So I started, learning things like economics and political science and math, and all the things that kind of make your brain form.
Sure.
And it turned out I was a pretty good student and I was really interested. So I ended up, again, great fortune. I ended up transferring to UCLA, where in my first quarter at UCLA, this is in 2003, in 2001. I graduated in 2003. In 2001, I walked into a classroom for a course in labor economics and labor unions. I'm sitting there, I'm, a good student. I'm sitting in the front row, and this guy walks in some version of, 15 minutes after we were supposed to start, wearing cowboy boots and sunglasses, and that's how I met Earl Thompson,
Wow.
who became a life-altering mentor. I learned so much from Earl. He was a true intellect. He was an independent thinker on all matters of economics. Again, he was teaching kind of oddball classes, everything from labor stuff to how to think about law and economics and so on and so forth. And it happened to be, as I noted, 2001. And so very quickly it became his teaching assistant, his research assistant, his co-author, which, is kind of nuts that I would be writing academic papers as an undergrad. And because it was 2001, and because Earl had both the political economy kind of background and, deep curiosity about how the world worked, we started talking about bubbles, right? I mean, the tech bubble had just burst.
Yeah.
And we spent literally hours upon hours every evening and tonight trying to figure out how this could possibly happen, right?
Yeah.
How something like the tech bubble could possibly happen. And of course, we started reading the history of bubbles and, wrote what I would view as, certainly a piece of academic writing that defined a lot of the ways in which I think about, markets, but I think an important piece because it frames, the modern super bubbles into the bigger context of how these things can happen. So I fell in love with economics. I wanted to be a professor. The truth is I wanted to be Earl. And I applied to, a handful of doctoral programs around the nation. Again, I'm kind of young and silly. I don't have much of an algorithm, so it goes something like, where am I willing to live?
Yeah.
So I applied, and I was always, a fan of California. I just wanted to stay at UCLA, so I applied to UCLA. I applied to a couple of schools, and the same kid who had told me years prior that I should go to Santa Monica College for a student visa says to me, possibly in a late-night drunken stupor, you should apply to Boston University BU. It's a private school. I'm sure they have money, which I did. And so I ended up getting into UCLA with no money, which meant I had to pay for my doctorate, and I certainly was in no position to do that.
Yeah.
And I got into Boston University with a presidential fellowship, which was, just an incredible gift to me. And so I probably made the first truly economic decision of my life. I reluctantly got on a plane to Boston, but it turned out to be, of course, a fabulous thing, right? As you said, I learned a lot about microeconomics and game theory, but I eventually walked into the business school at BU, where I met a guy who said to me, everything you like about economics in the real world, we call it finance. Why don't you do that instead? That guy was Tzvi Bodhi. Tzvi introduced me to people like Bob Merton at the time at HBS, so I took Bob's courses at HBS. Bob ended up being, my first boss while I was in grad school. I worked for him at Integrated Finance in New York for a hot minute. And along the way, Tzvi became my father-in-law. So, nice. There was a lot of really life-defining dividends coming out of that decision to go to Boston. By the time I got my doctorate, so I wrote my, dissertation on how to think about a combination of things, but really how to think about, planning under uncertainty and kind of life cycle planning, life cycle theory, introducing things like optionality, which of course is related to risk, career options, that sort of thing. And so it was a great application of, some of the very fancy math that I had learned along the way, and try to apply it to, to relevant topics.
Yeah, and both Bob Merton and Tzvi Bodhi,
Correct.
Study options a lot. Yeah,
correct.
Yeah.
But by the time I got, my doctorate completed, it became pretty clear that I wasn't kind of meant for an academic life. Certainly not then. I was a theorist at a time when empiricists ruled. Finance. But I had a valuable skill set elsewhere. I ended up being interviewed for a job in risk management, working for the Ziff family in New York. And this is, I guess, late 07, early 08, when I meet the guy who would then become my first real boss after Bob, Alec Crawford. Alec was, working for the Ziff family in New York, a very sophisticated family office, who, wanted to build out a more complete risk group, presumably because they saw, clouds on the horizon. Yeah. And so I ended up, being an option theorist and all of that, I ended up joining the Ziff, Ziff Brothers Investments, the Ziff family's family office, in June of 08, in risk management. Yeah. So that was the beginning of the next 6 years of my life, which was absolutely fabulous. Great culture, fabulous colleagues, and just living through and witnessing, this defining era that the financial crisis was.
And you got there just before the world exploded.
Yeah, but also, think about, of all the places to be,
Yeah,
to
that's
work,
right.
to work for a place with permanent capital,
Sure.
to work for a place where, the three brothers are in the building with us every day,
Yeah.
so that there is no distance, there's no, white space between what they want and what we're trying to do, and all of that, was very, very special. So at some point, a guy that I really appreciate now, I think we were, this is, closer to the end of our tenure. This is probably 2013, 2014 is when I left. One of the guys I worked very closely with said, "Look around," and I did. And then he said, "This is probably the best job we'll ever have," which I thought was, a sweet and self-aware kind of thing to say.
Mm-hmm. Yeah.
I ended up, after ZBI, I ended up again. We had the kids in Brooklyn, and I have twin daughters, California was still calling. So I ended up talking to friends at PIMCO, and they said, "Well, I don't know that there's anything for you at PIMCO, but we work very closely with these more academic types across the street, the guys at Research Affiliates. You should talk to them." So I ended up joining Research Affiliates in 2014. I was supposed to be on the investment side of things, working for the CIO, and then very quickly into my tenure, I think some of us looked at each other and said, someone had the wisdom to say to me, I guess, "You don't want to be running regressions for the rest of your life, do you?" Which was insightful. So I ended up building and running the product management function at Research Affiliates. Research Affiliates is $150 billion of assets around the world, roughly.
Yeah, that's right.
And so it was great. I learned, again, I had a fabulous boss, Katie Sherrod, my CEO. And so, Katie and I worked extraordinarily closely. And so I learned what it looks like to run the business side of an asset management firm, of a financial company.
Yeah.
And
pause for a second just to let
Sure.
our audience know Research Affiliates is they're probably, correct me if I'm wrong, they're probably famous for two big things. One is asset class valuation, and the other is probably smart beta, fundamental indexation.
That's
fair?
correct. That's
Yeah.
correct. The first thing you mentioned, asset class valuation, type of work leading into global tactical asset allocation type of portfolios, and very much in the same vein as, what other shops, are known for, things like what GMO puts out in terms of expected returns. But the thing that is, and this is something that I carry with me to this day, I loved the mission of Research Affiliates, which was to be creating products and tools that are transformational and for the benefit of investors. And again, I don't have an affiliation with Research Affiliates anymore.
Yeah.
I don't even hold equity in the business. I want to be clear.
Right.
There is no conflict in my saying this. But if you go to their website, there is an asset allocation interactive tool, which honestly I think is second to none, and it's free, and it's available to all to understand not just the expected returns in the same way that some other shops like GMO would put out, but honestly kind of look under the hood and understand where those return expectations are coming from. So that kind of empowerment, that leading with education in a kind of true way is something that I think is very special about Research Affiliates. And
It is a wonderful module on their website where you can go and look up whatever they think a certain asset class might return, and not just that, but why they think it will return that.
And I think, again, I spent a huge amount of time defining, documenting, whatever the word you want to use, our culture with Katie. And I think that's a great example of what a healthy culture in investing looks like. It's be transparent. By the way, be generous with your insights, because
Yeah.
it's all necessary but not sufficient to the business of running money. So it's okay. It's not like you're actually giving away the farm in a way. But the thing about being transparent and being generous with your insights is you can only be better off for it, because it also invites debate.
That's right.
And if you think you hold truth, that's got to be pretty close to the top of the list of cardinal sins in investing.
Yeah.
So anyway, so that was my time at Research Affiliates. It was great.
Yeah.
Katie retired in 2021 at the intersection of that and some degree of COVID era metaphysical, meaning of life stuff. I had started scratching my head about launching my own firm.
Yeah.
I ended up going back for a minute to kind of the family office world, and for a host of reasons, that again, I guess it wasn't a great match, particularly for someone who was, ultimately thinking about kind of being my own person.
Yeah.
And so I ended up launching Treussard Capital Management now, shockingly, 2 years ago. And it's been fabulous. It's been, it's been an exercise in, of course, bringing the sum total of everything I just told you, my experience, my knowledge,
Yeah.
my understanding of incentives and asset management, which is very important, to the task of managing client portfolios, of course, and that's the number one job. But it's also a platform to be exactly who I want to be, and a huge part of that is educating. A huge part of that is writing, and sharing my thoughts. I mean, which is why, by the way, I'm so grateful for the opportunity to share my thoughts with you.
Sure.
But I that there is as much psychic reward for me in the writing and all of that. So if anybody's ever curious, look me up on LinkedIn. I write a good amount on LinkedIn, but more importantly, I write this newsletter called Wealth Empowered, and it's on Beehive. But if you go to my website, Treussard.com, you can sign up there. And again, I write this kind of biweekly exercise in bearing my soul. I don't know how else to say it. It's as my wife has long encouraged me. None of that dear sir, madam nonsense. It's all very, very personal, and but it's about, of course, it's about the economy, and it's about markets and all
Markets.
of that.
Yeah. You wrote something recently called "Walking and Chewing Gum." Talk about that. What were some of the ideas in there?
Yeah, I mean, I write a lot, and walking and chewing gum. Obviously, the idea is can we carry kind of two tasks? Can we carry two burdens at once? And you have to, because that's, again, you have to lean into the possibility that markets will reward you, and that the economy will be fine, and that this fabulous engine of innovation and growth that human ingenuity is will continue. And of course, you can't be blind to the risks. That things could go badly for at least for a time. I mean, you just again. Anything short of that is hubris and blindness. I write about so many things that are really important to me. Some of them I feel like they're if I do it right, they're kind of public service announcement type of things, and I don't mean to only be the if not the bearer of bad news, the self-appointed messenger. But I talk about things like one of the other things that I've been writing about, which I think is very important, is what I describe as kind of the ETF 2.0 revolution, and the fact that for a very long time the ETF business was dominated by what the insiders would call core and bore strategies, the S&P or whatever, and they're core and they're boring, right? And part of that is to realize that if you're running an asset management firm, not a wealth management firm like me, but an asset management firm, like unless you're Vanguard or BlackRock or State Street, it's going to be really hard to turn up a profit because these are massively scale-driven businesses. And even they, I'm not sure, are having an easy time of turning up a profit. And so a handful of years ago, the genie was let out of the bottle and quote unquote interesting things, quote unquote exotic things started coming into the ETF space.
That's right.
And of course, some of them are probably good and decent, but there's also just a lot of stuff that is driven by a recognition that complexity might be a good cover for higher fees.
Sure.
And that in some other cases, you give people what they want, even if what they want is a pork chop and not a healthy salad for lunch. Right. And so, I talk a lot about that, about how do you think about covered called ETFs and how do you think about leveraged ETFs and not just ETFs, but 0 day to expiry options, and like, do we really think what evil genius came up with that? All of that sort of thing. So I
3 times NVIDIA funds.
But again, going back to this concept of walking and chewing gum.
Yeah.
It's very important to. While I may have opinions and I may be even cynical and possibly worried about some of these developments in markets, you can't, it's important to keep the flame alive that when they function, when they're operating as intended, markets are something like the 8th wonder of the world. I mean, they're a place for people to fund human ingenuity and kind of the human spirit. And so I find I get upset when they're corrupted, what I deem to be corrupted, right? But it doesn't mean we have to get angry with the actual thing, because I think the actual thing can be, in fact, not only can it be beautiful, I think it's necessary.
Yeah. Tell me about current views on markets. Your former shop Research Affiliates thinks U.S. stocks are overpriced and has been encouraging investors to invest in foreign stocks for a while now. Where are you? When you're constructing portfolios now, how are you going about it?
So, look, again, I'm a child of Research Affiliates for sure, and I've only ever worked at shops that I was aligned with and respected. Yeah. And you're right. Now, I will say it's interesting, right? Because as we're recording this, as we're speaking, it looks to me like U.S. stocks might be getting a little bit cheaper by the minute. But I'm being facetious. I mean, again, we U.S. stocks have been expensive for a period of time. And yes, on a valuation basis, international stocks have had the distinct advantage of looking more defensive and having more upside potential because, again, I think a lot about the philosophy of investing as much and the psychology of investing as much as the mechanics of investing. As we know, buying securities at very high valuations, sometimes generationally high valuations, just doesn't leave a lot of room for error. Yeah. And it is. I find myself shocked when logic prevails. And right now, logic seems to be prevailing in markets. Now, I don't know for how long, but over the last couple of months, we've had U.S. stocks kind of going nowhere fast, and in fact, giving back, having now given back the entirety of what was described as the Trump bump post-election. And international stocks, benefiting from the fact that when all the bad news seems to be in the price, that actually opens the door for surprises to the upside. Yes. And so the fact that international stocks have done so well and in fact, so well relative to U.S. stocks in an era, the last, roughly, I don't know where you start the clock, whether it's 90 days or 45 days, whatever in a world where we're being told that the rest of the world is not our friend, these stocks seem to be doing pretty well.
They do.
All of that. So that's part of it. I think it's just it's valuations. It's recognizing that dominant narratives have an uncanny ability to set people up for disappointment. Yeah. It's, to some degree, I think there is theater and theatrics. And so, watch what's being done, not what's being said. Mm-hmm. And then you look at, obviously interest rates are off of their recent highs, and they've come down hard. Now they've come down hard again, not for great reasons. I'm not sure that the people that were long duration, long bonds, it seems a little bit like a deal with the devil that, the 10-year yield is down 60 bips or something over the course of a couple of weeks.
Very large amount.
Really because the economy is starting to look a little bit on the edge of,
right.
Not really great stuff.
Yeah.
But, again, that's the power of valuations. When you start looking at things like, the 20 or 10-year treasury at, 5% or 6% in the case of the 20-year, like all of a sudden you're like, well, yeah, of course, bad things could happen. Yields could go from 6 to 7, from 7 to 8. But, gee, that's a pretty good place to start.
Yeah, that's right. Yeah.
That sort of thing. So, and then I'll say things that, everybody says because they're just painfully obvious. At generational lows in terms of credit spreads, well, is it really worth getting too excited about adding credit risk to your bond diet? I don't know.
Yeah.
And again, that's the easy one. The one that requires a modicum more of intellectual sophistication is option selling. When VIX is at 13, 14, like I'm not sure that it's worth getting out of bed to go sell a bunch of options.
Yeah.
Which is very different if we wake up tomorrow and VIX is at 60. Yeah. So that sort of thing. It's just shockingly, this stuff isn't that complicated. It just requires clarity of vision.
Yeah. Tell me where you stand, and if you incorporate any private equity or private credit into your portfolios, because that's been the trend, certainly a big trend in investment management over the last few years. I wonder if it was more popular when yield was so hard to come by before 2022. But tell me about that. What you think about that?
Yeah. So you asked two questions: whether they're kind of in my client portfolios and what I think. So I'll kind of separate the two out.
Okay.
By and large, the answer is no. They're not in my client portfolios or not with me, I should say.
Yeah.
My clients come to me for something else. Look,
Yeah.
if you want, and for me to pretend that I have either an edge or access to, the best and brightest in private equity and private credit would be a fallacy. And
Yeah.
I tend to lead with the world as it is, not as one would want it to be. So the answer is no. And my clients for whom that kind of makes sense, they're getting this stuff in their diet somewhere else.
Yeah.
I mean, some of them run companies that, for all intents and purposes, have the risk characteristics of being private equity and so on and so forth. And my clients, as they tend to be, who've done very well in life and as a result have generated substantial wealth over the course of a professional life. These people have their private equity and their private credit exposure elsewhere at the more traditional kind of private bank type of places. They come to me because of my understanding in markets, because of my profound focus on risk, and honestly, because when it comes to trading public securities on markets, I really believe that execution and trading matter. And I happen to be, I have to have experience there that has taught me when to be patient, when to hurry up, that it's probably good for you to not kind of jam all the trades in because today's the day we put the investment plan to work, that sort of thing. So that's the inside kind of logic. The outside reasoning on what I think about it, again, I mean, people forget all too quickly that private equity is equity.
It's equity, yeah.
That it happens to be private and therefore illiquid, and along for the ride is a healthy dose of leverage.
Yeah.
But it's just equity. And so, yeah, of course, private equity has been looking like a hero for, a long time in an era where just equity markets, particularly U.S. equity markets, have just looked fabulous. So if you take a thing that's performed great and you lever it up, 4x, it's going to look great. Now,
yeah.
There might be something to be said for understanding fees and where the money's going and how much of the great is being captured by the investor and how much of it is being captured by the shop.
Right.
But it's all kind of another day at the office type of thing. Same with now. Again, Cliff Asness at AQR, of course, I think is kind of fundamentally right about private equity.
Yeah.
People pay for illiquidity because it's like but it's like, hey, you're paying for a service here, and it's not an investment service.
Yeah.
And all of that. Private credit, again, there's nothing functionally wrong with it. Again, it's funny that people seem to forget that credit's credit. And so, once upon a time, there was bank lending, and then we told the banks, don't do it anymore. We didn't like what happened during the financial crisis, and a bunch of people kind of, saw a breach in the wall and ran through it.
Yeah.
And so what we have is a regulatory arbitrage type of thing, where once upon a time regulated activity has been, taken on by unregulated, non-bank. I don't mean unregulated. I mean not bank regulated players. Now I will say, and again, one of my other mentors and good friends, Larry Kotlikoff, wrote a book in the aftermath of the financial crisis. And I think I'm going to get the title right, but it's approximately right. Something like Jimmy Stewart's Dead. And it was all about the fact that banking was broken and that the moment you have a mismatch between assets and liabilities, then of course the devil's in the machine. And so Larry made and again, I want to be clear, I love Larry. He's one of my closest friends. But he made the radical proposal that we should kind of do away with everything that actually isn't a mutual fund. Because, at least and I think that's so, yeah, it might be true that private credit, to the extent that it's not bank-based and that it's investors going into it eyes wide open and taking their marks, there might be less kind of quote-unquote systemic risk from that standpoint, but not entirely. Yeah. And that's the thing that I worry about a little bit, which is there might be a little bit too much excitement because it's been hot and because it did well, particularly in 2022, and everything else did extraordinarily poorly because a lot of these loans are floating.
Yeah.
But again, all that's kind of functionally like that stuff we can deal with. Now I tend to think that regulatory arbitrage, at least in a normal world, which I'm not sure we live in a current normal era, but things that used to be regulated probably were regulated for a reason, and we're going to find that when you extend credit, sometimes bad things happen, and there might be risk there. But the thing that worries me more is the incentive side of things in asset management and the fact that we're shoving private assets inside public vehicles like ETFs, and we're shoving these public vehicles and others, down the throats of less sophisticated investors who think they're getting access to what the big boys usually have access to. And I just, Jason Zweig wrote a fabulous piece a little while ago, and it was something like, Wall Street's inviting to their private party. Tell them you're busy.
Right.
Yeah, how often is Wall Street inviting you to their very special VIP party?
Right. Right. It's an opportunity for them to probably make more fees, more than anything else, than to help you in some fundamental way. Very good. I didn't ask you. We started with music. What instrument did you play when you first arrived in Los Angeles?
Guitar.
Guitar. Okay.
But I grew up. I am musically curious in all the ways you can imagine. So I've never met an instrument I wasn't curious about. So I played all sorts of stringed instruments. I dabbled in playing drums. In fact, we were at a party a couple months ago, and there was a drum kit, and I went behind the drum kit and I started playing. And my wife was like, "You know how to play the drums?" And I was like, "Who doesn't?" At some point I decided I was going to learn to play the trumpet, so I got a cheap trumpet on Amazon. That was kiboshed quickly in my household.
Yeah.
But yeah, no, I play guitar.
Yeah, that's great. What kind of music did you play growing up, or did you like, or were you attracted to? Was it blues or?
Yeah, so I grew up in Paris. I played a lot of jazz, and I had this fabulous mentor teacher who was a descendant of kind of the gypsy jazz tradition, but rebelled. And again, I rarely come across a rebel I don't like. He rebelled and didn't want to be kind of put in a box playing gypsy jazz, so played a lot of bebop. Yeah. So that's kind of what I grew up with. But when you're 17 years old and it's the late 90s, you think Slash is pretty cool.
Right.
So all of that.
Yeah, that's good. Yeah, I took piano lessons as a kid a couple of different times, but I was just much more interested in baseball, so it didn't work out. But I have it in mind to pick up the guitar at some point. I'd like to do that.
It's fun. It's great. I'm immune to organized sports, so that's my secret weapon. My eyes glaze over the moment there is guys in jerseys on a TV screen. So
right, that's good. That'll help you with music.
Exactly.
Very good.
It makes room and time for music.
It makes room and time for music. That's right. Jonathan, where are you located these days? Where's headquarters for your business? Is it Los Angeles
Newport
or is
Beach.
it
Newport Beach,
Newport
California.
Beach? Okay, so
Yeah.
you stayed close to research affiliates and PIMCO.
It's hard to. This is a very special place. I mean, it's just. I mean, obviously the natural beauty is very real.
Yeah.
And the quality of life is incredible.
Yeah.
As a result of that, when I'm not working, I can go, trail running and whatever.
Yeah.
But it's also become, and I grew up in I guess, you kind of make assumptions based on the way you grow up. And, I grew up in Paris and I lived in LA and Boston and New York. Like, I always thought anonymity was one kind of baked in.
Right.
To the modern lifestyle and kind of like a positive feature, right?
Mm-hmm.
And I love that Newport Beach, and I've grown to love the fact that Newport Beach is kind of a village, and I have, we have a real community of friends and neighbors and all of that. That honestly, I think would be. Look, we have extraordinary friends. In fact, some of our best friends are the friends we made in Brooklyn.
Mm-hmm.
But the ability to go down the street and literally like wave at people because you know them from the school and from the shop and from the this and from it's kind of cool. So we're here.
So that's great. Yeah, no, it's a beautiful place, and I lived in California 2 different times and really enjoyed it. Hope to make it back at some point.
No, you should come visit.
Yeah, I will definitely. Jonathan, anything else you want to leave us with regarding markets, regarding your business, anything at all?
Recently, I was talking about, I had this tagline. The first tagline in this concept was, bubbles used to be hard work, you know? And what I mean by that, or what I meant by that, is having been a student of bubbles, once upon a time, if you were kind of doing, kind of a fraudster bubble thing, you had to at least put up the effort of pretending. If you were Elizabeth Holmes at Theranos, you had to pretend to have like the working machine, type of thing.
Right.
And so I worry that once upon a time, bubbles used to be hard work, and maybe they're not such hard work anymore. And that's kind of the meme coin thing and all of that. Look, when you can create a quote unquote asset overnight with no effort, and the valuation is solely predicated on people liking you, like that's not a valuation model. And then people say to me things like, "Well, yeah, but that creator still holds 80% of the float," and I'm like, 80% of something that was worthless yesterday and required no effort to create is not an alignment of incentive.
Right.
And so that's the thing that I will continue to worry about for the foreseeable future, is what I would describe as the suspension of prices. Yeah. And there are a lot of ways to think about suspended prices. Obviously, what I just described to you is the comical version of it. Yeah. But other people, very smart people, worry that passive investing, the fact that you're, a fraction of your paycheck is hitting the market every 2 weeks, and it's price insensitive.
Regardless of price, yeah.
Right. The moment we become price insensitive at scale, I'm willing to believe there is a distortion. So Anyway, that's the thing about markets that I continue to be sensitive to, and that is the thing that I will continue to write about because I'm trying to make sense of it. Yeah. And so I hope people will come along on this exploration with me.
That's a great place to end, Jonathan. I think too many investors are not sensitive to price. They don't realize the asset they're buying may be a perfectly good asset, but could be overpriced as well, which could not make it a good investment. So. Correct. Excellent place to end. Jonathan Treussard, thank you so much. This has been a real pleasure. Appreciate it very much. Thanks for coming on the podcast.
Thanks so much.